Good evening, everyone. My name is Paul Young. I'm going to walk you through a policy called negative interest rates. So my presentation will be only one perspective of negative interest rate. You're more than welcome to go out to the internet, especially to bank sites or government sites, to get their perspective of negative interest rates to frame the whole concept up. My goal is to try to introduce you to what it is, what's the risks to it, and how it impacts both government policies as well as business policies as well as household debt. A little bit about myself. I've been in business for 25 plus years. I've got in-depth understanding from academia, industry to financial solutions. I'll talk about what interest rates are, what's the downside to them, what's the upside to doing that policy. I'll talk about government policies, and I'll talk about business policies. Now, typically what a negative interest rate is, you're now going below 0% in offering these interest rates. The idea is you're trying to encourage a different way to stimulate the economy, to increase people wanting to borrow more money. So, other words, basically you're trying to stimulate people to borrow money, and that money might be put into either household debt or into business investment. So that's the idea, or even with government in terms of infrastructure. That's the idea. The other idea with it came into play is that you've exhausted all attempts to do certain things. So in other words, all monetary policies haven't worked to the degree that the central banks wanted it to. So right now that's what you're seeing happen. The only country that's actively really doing it is Japan. Some other banks in Europe are considering doing the same push. So basically, if you really think of it in a nutshell, the negative impact as a country, okay, there's two things that drive a country. It's currency rates, okay, because it allows you to export and import goods. So if you reduce your currency down, it's going to add in imports. So if you're importing a lot of goods, it's going to add the cost of imports, which pushes the cost of inflation up. The other thing too is when you start playing games around loan management, you start getting into your capitalization issues. You also get into, how do I offset these low returns with a higher rate of returns elsewhere? So the banks have to manage their capital in terms of their net interest margins. And that's what's really happening here with this statement as well. That's what you're seeing. Now, by doing this, as I said earlier, governments are now reached their policies in terms of what they can do in terms of manage interest rates. So they're at their last ditch effort in terms of the setting policies. The positive sign now with negative interest rates is, as I said, I can make it in three statements quickly. The idea is you're trying to encourage people to spend money in the economies, because 2/3 of GDP is driven by consumer spending. So you're trying to get people to spend money. You're also trying to encourage business to invest. Well, business will invest if they need to add capital or in terms of efficiency. They'll get into that. But realistically, you need to be very careful in terms of your policy. And that's what basically they're saying. It will help, but does it really help enough? Is there other things that can be done? That should be the questions asked. Now, here's the issues of government policies. You're talking a central government policy, okay? You've got a huge issue with consumer debt. So playing games with interest rates doesn't change the consumer debt. You also have high tax burdens, okay? Some countries are up to 55 cents of every dollar is collected from tax. You're not helping people spend money. You're not giving incentive for people to work more. You're also seeing lack of capital investment, and you're seeing low commodity prices that impact business investment. So central government policy, even if you change rates, doesn't change the holistic issues facing some of these areas. And that's a key thing to bear in mind. What should government do other than looking at interest rates? Well, it needs to get its house in order, its fiscal house in order, from looking at value for money on the way it delivers social programs. It also has to do wage, pension, and benefit reforms of the public sector to bring those costs down and align them with the private sector. It needs to work with banks to revisit the mortgage rules, look at valuations, look at foreign ownership. It needs to look at that. Government debt, it needs to come up with a repayment cycle, and it needs to look at how it manages its deficits. Infrastructure, it needs to make key infrastructure investments that move people to market, move people around through transit or goods to market. Those will generate income that will support social programs, and no need to basically rely on low interest rates to do it. It needs to focus on government taxation policies for innovation, tax reforms, and not introduce policies like carbon tax or pricing that add more costs. So government itself needs to get its fiscal house in order. What does business do? Well, business can do a couple things with low interest rates. It now has cash sitting on its balance sheet. It needs to redeploy that cash. It can look at purchasing capital assets. It can go on a mergers and acquisition way. It can go into a global expansion now because it has the cash and wants to do it. It can start repatriating cash through different options like R&D investments. It can look at dividend payouts. It can look at stock repurchase plans, and they can look at debt repayment plan as part of managing with the low interest rates to pay some of that debt down. What can households do? Well, households can do debt refinancing because their rates are down low. They might even take out a home equity loan to make improvements to the house. They can look at other investments that are giving a higher rate of return in terms of tax-free saving accounts that are going into mutual funds or stock investments that pay dividend yields. You can look at pay down your mortgage. So in essence, when we take a step back, I don't support negative interest rates for a couple reasons. One is it doesn't fix the systemic issues that are facing government, households, and business. It doesn't fix that. Also, it isn't one policy that's going to support economic growth or support any sort of program delivered. It's going to be a combination of policy. To pick on one policy doesn't necessarily make it will work. So I'm not in favor of negative interest rates. I'm in favor of restructuring government, looking at household debts, and getting into the root causes of the issues. If you throw money at the symptoms, the problem never goes away. So trying to fix the debt issue by messing around with interest rates won't fix the systemic issues that are facing both government, personal, and business. And that's the reason why I've taken a step and say I don't really support it. Now, this is my opinion on it. It doesn't mean other people don't support it, but I believe that there's a bunch of policies that have to get together in order to benefit the economy as well as get control of debts. And that's very critical because as we move forward, there's rules coming into play on Basel III reporting on the debt capitalization that banks need to make sure that they keep their capitalization rates at a good ratio because we don't want to have insolvent banks. And this is a thing that we need to bear in mind. The tighter on the interest margins is also critical for the banks because they have to make their margins calls. So that's something else to bear in mind. So I encourage any of you who want to learn a little bit more about videos that you go out and search the internet and get different perspective of it. You don't take just what a party policy is set by a government or an individual. You go out and do your research. Thank you.